Welcome back to The Explainer, folks. I am so incredibly excited to dive into today's topic. We're about to jump into what is literally the ultimate masterclass in wealth creation. We're going to decode the investing playbook of the absolute master himself, Warren Buffett. Using insights straight from self-made millionaire Adam Koo, we'll break down exactly how the rich manage to grow their money safely and consistently. If you want to stop guessing and start building some serious, lasting wealth, you are absolutely in the right place.
All right, let's start with a bit of a massive paradox. Historically, the overall stock market has consistently gone up over the long haul. It averages solid returns. Yet, the vast majority of everyday investors actually lose money. Why is that? Well, Adam Koo uses this really fantastic analogy. Imagine handing the keys of a Formula One race car to someone who has zero advanced driving skills. You tell them to go hit the circuit at 230 kilometers per hour. What's going to happen? They're going to crash and burn. And honestly, most average investors are doing exactly that. They're jumping into the high-speed world of the stock market without any real financial training.
And that lack of training completely violates the single most important philosophy of master investors. Buffett puts it best: rule number 1, never lose money. Rule number 2, never forget rule number 1. It sounds simple, right? But Buffett's entire core strategy is all about capital preservation. See, true investing isn't about gambling. It's about minimizing risk. Buffett is extremely risk-averse. He only puts his money down when the downside is incredibly low and the probability of success is extremely high.
Okay, so to get you thinking like a master investor, here's our playbook for today's explainer. 1. Why most investors lose. 2. The Buffett mindset. 3. Spotting a great business. 4. Finding intrinsic value. And 5. Knowing when to sell. Let's dive right in.
Section 1. Why most investors lose.
So, the average investor generally doesn't use financial intelligence. Instead, they rely on raw emotion, specifically fear and greed. Basically, they treat the stock exchange like a giant casino. Their greed pushes them to buy when prices are already rocketing to the moon or just because they heard some hot tip at a dinner party. By the time they actually buy, the stock is already horribly overvalued. Then, out of nowhere, a recession hits or some temporary bad news causes the price to dip and total panic sets in. Fear completely takes over and they stampede to sell at a massive loss. That kind of ignorance and herd mentality practically guarantees they're always buying high and selling low.
Moving on to Section 2. The Warren Buffett mindset. There is such a stark contrast here. The average person actually thinks the market is rational. They think you have to diversify your money everywhere just to be safe, and that super high risk is the only possible way to get high returns. But a master investor, someone like Buffett, he believes the exact opposite. He knows the short-term market is totally irrational, driven entirely by those emotions of fear and greed we just talked about. So instead of diversifying blindly, he concentrates his capital in a few incredibly strong businesses that he deeply understands. He doesn't buy on emotion. He uses strictly defined criteria, he buys on bad news, and he sells on good news. Which brings us to another brilliant insight from the Oracle himself. Risk comes from not knowing what you are doing. You see, risk is entirely contextual. Think about it. If you try to climb a massive mountain with absolutely no training and zero gear, that's incredibly dangerous. It's practically a death wish. But for a highly trained professional with the right equipment, the risk is minimal. It's the exact same deal with stocks. Buying stocks without thoroughly analyzing the actual business behind them is financial suicide. But with high competence, it actually becomes a low-risk, high-return game.
All right, Section 3. Spotting a great business.
Now, what's absolutely vital here, the true marker of a great business is something called an economic moat. Basically, a great business has a wide, deep moat protecting its castle of profits from invading competitors. This could be an unstoppable brand presence, like you see with Coca-Cola or Nike, exclusive patents, or massive economies of scale, like Walmart has. Having this moat means they don't have to compete purely on price. They can charge a premium, keep their customers loyal, and essentially guarantee future growth without getting dragged into devastating price wars.
Another absolutely crucial indicator is the return on equity, ROE. This metric measures exactly how efficiently a company uses the money shareholders have invested to generate pure profit. Now, your average run-of-the-mill company might have an ROE around, say, 12%, but a master investor, they're hunting for the rare gems. They want companies that consistently generate a high ROE of over 15% year in and year out. So let's pull this together into Adam Koo's ultimate business quality checklist. A master investor will only move forward if a company checks all of these boxes. Ready? First, a consistent history of growing sales and earnings.
Second, that wide economic moat we just talked about. Third, clear drivers for future growth. Fourth, conservative debt, meaning debt that could easily be wiped out by just 3 to 4 years of earnings. Fifth, a consistently high ROE above 15%. Sixth, low capital expenditure, or CapEx. That just means they don't have to constantly buy hugely expensive new machinery just to stay afloat. And finally, an honest, highly competent management team that actually cares about the shareholders. You need the whole shebang.
Okay, Section 4, Finding the Intrinsic Value. I want you to think about this question for a second. What is the absolute maximum you would pay today for a machine that is 100% guaranteed to generate $100 exactly 1 year from now? I mean, you definitely wouldn't pay $100 for it, right? Because you have to wait a whole year just to break even. You'd pay something less than $100. And that right there is the foundational concept of intrinsic value. Money you get in the future is always worth a little bit less today.
So to figure out what a stock is actually worth, its true intrinsic value, you basically just follow 3 steps. Number 1, project all the cash the business will generate from its operations over the next 10 years. 2, you discount all those future cash flows back to what they're worth in today's dollars. People usually use a risk-free interest rate for this. And 3, you add all of that up and divide it by the total number of shares outstanding. That math tells you exactly what one single share of the business is truly worth based entirely on cold, hard cash generation. You completely ignore whatever crazy volatile price the stock ticker is shouting at you today.
Let me show you just how powerful this is. 36%. That is the massive discount Adam Koo received when he bought stock in AIG. Now, AIG is a fantastic company, but back in 2005, they got hit with an accounting scandal. The totally irrational market panicked and actually drove the stock price down to $52. But Koo did the math. The actual intrinsic value of the company was $80. So while everyone else was running away screaming in fear, he stepped right in and bought a phenomenal business at a massive 36% discount.
So here's the absolute crux of the master strategy. You find a great business, and then you do absolutely nothing. Seriously, you just wait. You wait for a temporary disaster to strike. It could be a recession, an overblown PR scandal, or just general global panic. You sit back, let the irrational market freak out, and watch them sell off their shares. And then you strike. You buy into that great business at a massive discount to its intrinsic value. Boom, you instantly have a huge margin of safety.
Which leads us to Section 5, Knowing When to Sell.
You know, average investors are super quick to sell when a stock drops 20% out of pure fear. Or on the flip side, they'll sell when it goes up just a tiny bit, trying to lock in a meager profit. Master investors literally never do that. If the stock drops due to a temporary recession or some fleeting bad news, you hold. Honestly, you should probably be buying more. If the price rises but is still hovering below its intrinsic value, you hold. You really only ever sell if you realize you made a mathematical mistake in your initial evaluation, if the company permanently loses its economic moat, or, and this is the absolute best case scenario, if the market gets so wildly optimistic that the stock price finally shoots way past its true intrinsic value.
And I think this brilliantly illustrates the ultimate secret to building $1 million net worth: unshakable patience and discipline. Think about it. When the economy is absolutely booming and everyone at the office is loudly bragging about their stock portfolios, the master investor just sits on their cash. They stay right on the sidelines. They save their capital for that inevitable moment when the market crashes and gets weak. Guys, that is exactly when millionaires are made.
So, I'm going to leave you with this one question to chew on. Are you ready to stop treating the stock market like a slot machine and start actually buying great businesses? By adopting the mindset of Warren Buffett, strictly relying on structured checklists, and doing the math to find intrinsic value, you now have the literal blueprint to take control of your financial destiny. You really don't need luck. You just need discipline. Thank you so much for joining me on this explainer today, and I really hope you feel empowered to go out there and put these master strategies into action.